In this video, we're diving into the world of fraud. We'll uncover what it is, how it sneaks its way into financial statements, and what companies can do to spot it. Plus, we'll take a deep look at the surprising reasons why some employees just don't report fraud, even when they know something shady is going on. Ready to unlock the mysteries of fraud detection and prevention? Let's go. Fraud is the deliberate misrepresentation to gain an advantage over another party. Fraud comes in many different forms, including fraud in financial statements, the theft of assets, and subsequent cover-up and disclosure fraud. Just to make sure we clarify this, fraud is not the same as an error, which can occur innocently. Fraud is a purposeful act to mislead others. A common element of fraud is that it leads to material misrepresentation of the financial statements. How was fraud detected? According to the ACFE's study of occupational fraud, the most common method of detection was a tip, with 43%. In organizations with hotlines, 49% came from a tip, but declined to 31% in organizations with no hotline. Internal audit was next with 15%, followed by management review with 12%. The external audit only detected fraud in 4% of the cases. That means that the company should not look to the external auditors to detect fraud, but rather build and maintain strong internal controls and implement an effective audit committee. To spot fraud before it happens, look out for red flags. Here's some of the top indicators. Living beyond one's means with 42%, big spending with no obvious source of income. That could be a problem. Financial difficulties with 26%. Financial stress might push someone towards unethical behavior. But how do we spot these issues? Internal controls can help identify these behaviors, and some telltale signs might pop up in relationships with customers and vendors, like overly close associations, perhaps a little too cozy, or a wheeler-dealer attitude. Plus, if an employee refuses to take their vacation days, that could mean they're trying to hide something. Companies often require employees to take at least 5 consecutive days off to make sure everything is above board. While internal controls won't guarantee fraud-free operations, they certainly help deter fraud and mitigate losses. And let's not forget hotlines. 43% of frauds are detected through tips. So why not have a hotline? Yet shockingly, only 64% of companies have one, and just 13% reward whistleblowers. But hey, if you have a strong internal audit team that's tuned into red flags and potential conflicts of interest, you'll be a lot more ahead of the game. Okay, here's a little twist. Even though external audits catch fraud only 4% of the time, it's the most common anti-fraud tool companies use. Why? Because it's required by the SEC for public companies. But don't let that fool you. External audits aren't really fraud detectors. They might deter fraud, but the real work of preventing fraud happens with strong internal controls. So what works best? Tone at the top, when leadership walks the walk and emphasizes ethical behavior. Add an internal audit department, conduct frequent reviews, and have management certify the financial statements. These are the anti-fraud controls that really get the job done. Reporting fraud isn't as easy as it sounds. Why not? Well, a whole bunch of factors make it tough. For one, it could be the poor tone at the top. If management doesn't value ethical behavior, why would employees? Another factor might be intimidating personalities. Employees may fear retribution or retaliation, or they might feel loyalty to colleagues. There's also the fear of the unknown. What happens if I report this? Will I lose my job? Or lack of trust. If employees feel like their concerns won't be taken seriously, why bother reporting? Many companies are addressing these fears with anti-retaliation policies and procedures on how to handle whistleblower reports. So when choosing an employer, don't just look at the pay. Check out the company's culture and ethics too. Financial statement fraud can be sneaky. There are three main ways it manifests. For instance, revenue overstatement. This could involve recording sales that haven't happened yet, booking sales for other companies, or even selling products that aren't really sold, like consignment items. There's expense understatement, which occurs when people try to sneak costs into the wrong category or simply not report some expenses. Improper asset valuation includes manipulating reserves, overstating asset lifespans, or ignoring necessary write-downs. All this helps create a false picture of the company's financial health. It's like putting a fresh coat of paint on a car with a broken engine. Looks great on the outside, but it's not going to drive anywhere. Fraud doesn't just appear out of nowhere. There are three things that almost always play a role in financial statement fraud. One, there's the situational pressure that pushes someone to do something they normally wouldn't do. Two, then there is the perceived opportunity, the belief that they can get away with it. Fraudsters often think I won't get caught, which makes it easier for them to take the risk. And finally, there is rationalization. This is where the fraudster justifies their actions. It's only temporary. I'm just helping the company. It's all about convincing themselves that the behavior is acceptable. And voila, that's what we call the fraud triangle, where pressure, opportunity, and rationalization meet and fraud occurs. As auditors, we're trained to look for these red flags when designing our audit plans. Spot these three factors, and you might just be able to catch fraud before it becomes a big problem.